I'm the first to argue that the financial industry represents too large a portion of GDP. The entire financial industry, for the most part, is just middlemen and women shuffling papers. They operate like a marketplace for money, connecting people who have it with people who need it. But they don't themselves produce anything of value. They only facilitate the ability for others to produce something of value by removing friction from transactions. The more friction they remove, the more useful their service. But ultimately, the less we spend on finance while maintaining the same level of service, the more we have available to spend on other things that actually produce stuff. And we want more stuff, not more banking. In that sense, the financial industry is like a tax on the economy. Every penny consumed by a bank is a penny not invested in a factory, a restaurant, a home builder, a university. That sounds dramatic, but it's basically true of any service. If we can maintain the same service level of anything and pay less for it, the entire economy benefits. Efficiency makes us more productive. Productivity makes us more wealthy. Nobody loves their bank, but when people complain about them, the currency used to denominate the balance in their account is probably near the bottom of the list of concerns. People want good service at a fair price more than anything else. So when evaluating the utility of Bitcoin in the context of replacing banks, what matters is only the banking functions it could replace. Does it remove more friction from transactions? Which ones? What exactly does Bitcoin do better than a bank? Bitcoin does not remove friction from daily transactions. I don't really feel the need to justify this point of view. Anybody who has ever purchased anything with a card in person or online or used something like Apple Pay knows that friction isn't a big problem today. One might argue the traditional financial system has excessive fees paid by vendors who accept credit cards, but Bitcoin doesn't really fix that. Bitcoin fees fluctuate just like its price, but it tends to have a higher transaction fee than traditional methods of payment, including credit cards, but especially debit cards or direct bank transfers from services like Zelle or Venmo. One might argue the traditional financial system is not accessible to all people because of ID requirements or minimum fees, but Bitcoin doesn't really fix that either. It's true that nobody can stop you from creating a Bitcoin wallet, but it doesn't really matter if nobody will accept it. There is also nothing stopping me from writing $1 billion on a piece of paper in my pocket, but if nobody will accept it, I can't say I solved accessibility problems. Bitcoin is also more likely to result in loss from fraud, scams, hacks, thefts, or simple incompetence. Bitcoin definitely can be cheaper than some wire transfers, in particular international, but not always because fees fluctuate so much. Bitcoin also can be much faster, especially at night, weekends, or holidays, but we aren't really comparing apples to apples. Banks are subject to all kinds of regulations that introduce costs and delays. If you believe regulations trying to prevent or limit tax evasion and money laundering are good, then one must ask whether Bitcoin would still be better if it were subject to those same rules and costs. If you believe the regulations are bad, either they should be changed, in which case bank costs would come down along with their fees and delays, or eliminated, in which case we would actually have a level playing field in which to compare the alternatives more fairly. In any case, it's kind of irrelevant because the delays in the traditional financial system are certainly not technology constraints that can only be solved by blockchains. Bank-to-bank transfers are much faster in parts of Europe, even with regulations and without any blockchains. So the current situation may present an advantage for Bitcoin in some cases, but the current situation is almost certainly temporary, and the need for Bitcoin to fix them is far from necessary and definitely not inevitable. Also, Bitcoin may be more secure in some sense, but I wouldn't equate that with more safe. It's more likely to experience wild price fluctuations, even in the few minutes of transit, let alone the time it takes to get through on and off ramps to the traditional financial system. It may also give you massive anxiety that your funds will be lost by user error or fraud by an intermediary, if you used one. Crypto loans are fascinating. Please correct me in the comments if you think I got this wrong. But as far as I can tell, people only borrow crypto for one of two reasons. Either they are borrowing non-stablecoins to leverage up their speculative positions, or they are borrowing stablecoins as short-term liquidity to fund life without paying taxes by avoiding the need to sell their speculative positions. In both cases, they are assuming massive downside risk of bankruptcy should the price of their speculative positions decline. But more importantly, in both cases, they are not doing anything productive that adds value to the economy. They're just shuffling pretend assets around a magical decentralized spreadsheet that matters only to themselves. If crypto lending disappeared tomorrow, I doubt anyone outside the industry would care or even notice. In the traditional financial system, that couldn't be farther from the truth. Many economists argue the housing market is the economy because it represents such a large portion of spending and has such a big influence on consumer behavior. And the housing market is very much facilitated by lending from banks. But if we look at the mechanics of how crypto loans work rather than why people choose to borrow crypto, taking digital collateral with loan-to-value ratios that can automatically trigger margin calls or liquidation events is neat, but not new. People can sign up for margin accounts from their investment bank and get the same treatment using stocks as collateral. The important thing here is they require digital assets, so these crypto loans can't apply to the real economy anyway. Other than finding creative ways to use fairy dust to leverage magic beans, I'm not sure where the innovation is. The one clear advantage of crypto is uniformity across borders. In general, I'm a fan of standardization. It makes life easier for everyone. But in this case, crypto people probably aren't the best ones to be making those standards. They like to say crypto is trustless, but it isn't really. Most people would only interface with crypto through intermediaries, and just by the very nature of how crypto works, to use their services, you have to trust them. Regardless, even if banks lost a non-negligible portion of their cross-border interbank business, the vast majority of banking use cases are domestic, not cross-border, so I wouldn't expect that to be sufficient to replace banks, which was the question being asked in this video. The bottom line here is that some crypto people may find a few advantages in corner cases here and there, but they certainly aren't putting banks at risk of irrelevance. At best, they will cause governments to re-evaluate regulations and determine which ones are still relevant, or can be modernized and standardized across borders. Any forcing function that encourages people to find ways to offer better services with less friction and less costs could be good. For example, text messages used to cost 10 cents each. Then once instant messaging using data came along, text messages became free. That's not a coincidence. Competition is good, and cheaper services will make the economy more productive. If you found this content helpful, please consider liking the video and subscribing to my channel. It really does help get this channel more exposure and keep me motivated to produce more content.